Hi there! You're invited to listen to an exclusive excerpt from the next episode that I'll be publishing on Sunday. My next guest is absolutely fascinating, and this is just a teaser of what you can expect from our discussion. Enjoy listening, and I'll see you on Sunday for the full episode.
Welcome to Finscale, a podcast created by Solène Niederkorn, shedding light on innovation in finance, banking, and insurance.
All about alternative assets. Bill Kelly, CEO and President of CAIA Association.
KKR came out with a recent fund offering. Very traditional alternative offering, private market offering, I think in the healthcare space, Cayman-based fund. But this feeder fund's hanging off. And one of the feeder funds is on the blockchain. And I find that exceedingly interesting because the underlying asset, it's probably off-chain, tied to these portfolio companies, but the fact that it's on a blockchain where if investors want out, they have to gate the fund and raise liquidity. This blockchain offering, this feeder fund, they don't have to raise liquidity.
In this episode, we take a step back to understand what's taken place in private markets and in particular in private equity. You'll not only discover that this asset class was almost non-existent 40 years ago, but also be treated to a discussion on the main principles of diversification and the evolution of a pension fund's asset allocation. This topic is important because we know that there are huge challenges when it comes to accessing this asset category. We are therefore talking about financial education, but also about tokenization. We delve into ESG and Bill's views about how hard it is for asset manager to implement its principles. Finally, we talk about the CAIA Association, their programs and alumni, and their initiatives, which will give you deeper insight into how education and recruitments in tech are key to the development of this asset class. Enjoy listening! Hello, everyone. Hi, Bill, and welcome to Finscale.
Great to see you again, Celine. Thanks for having me.
I'm really happy that you accepted my invitation because last time I heard you was very insightful and very interesting. So I hope you can share as much information as you can today. But can you please introduce yourself?
Sure. So I'm Bill Kelly. I'm the current CEO and president of the CAIA Association, which we can maybe discuss in more detail in a moment. But I've held this role now, actually I'll be beginning my 10th year in another couple of weeks, which is hard to believe. But we've been around for 20, so about half the life of CAIA. I've had the honor and the privilege to serve as the CEO of this organization. But I've spent 40 years in financial services. So I think this is a culmination of a lot of experience in a lot of different asset classes. And it's the very best job I've ever had.
Cool. You were investment manager previously.
Yes. So I started out as an accountant with Price Waterhouse out of school before PwC. It was the Big 8, not the Big 4, to show how long ago it was. But then moved to Boston from New York in 1988. And the vast majority of my career during that period of time was on the buy side of asset management. I was with the Boston Company, which was owned by Shearson, Lehman, and American Express, then sold to Mellon Bank before BNY Mellon. And I learned a lot about how to run an asset management firm inside of a large complex. Then 7 of us, without a paperclip to our name, started a firm called Boston Partners in 1995. So very much understood the venture capital startup space as well, firsthand as an entrepreneur, and sold that business to Robeco in Rotterdam in 2002. So got international experience as a result of that. And Robeco had acquired a few asset managers here in the States, and I became CEO of the U.S. operation. So a lot of different perches in the course of this career, and I learned a lot and took away a bit from every one of those experiences, which has served me very well today.
Excellent. Thank you very much. So I was very interested to have you on my podcast because you have a vision and a lot of information with regard to private markets and alternative investments. It's an asset class that I've seen as investment manager when I started at UBS like 20 years ago. That was still a very small and niche asset class compared to all the bonds and fixed income and equities, I would say standard asset classes of listed assets. This is something that maybe we can start with is that you explain to us how the diversification evolved those last 20 years.
Sure. So the concepts of hedge funds and private capital have been around for decades. And I think the first hedge fund started in the 1940s. So these are not new terms, but I think in terms of moving toward Main Street, these concepts are maybe a little bit new and maybe very much misunderstood. But if I look at the beginnings of the endowment model, which is really diversification across the traditional space, stocks, bonds, and cash, that was brought forward by the Common Fund, believe it or not necessarily the big Ivy League endowments and not necessarily David Swensen at Yale. Swensen perfected the model. But the concept was, if I look at the liability side of my balance sheet, and the principal is not going to be drawn more than maybe 5% every single year, it allows me to invest much more long-term and capture, as the story goes, an illiquidity premium, a complexity premium, and off you go. And the endowment model was born this way, and there are great inefficiencies in that market. And if I'm thinking about capturing alpha, it's found in pockets of inefficiencies. And when I last saw you in Luxembourg a couple of weeks ago, I did stop at 3 different universities in that tour, which I love talking to these students. And this very topic came up with them. And there's a chart I use when I talk to the students all the time just to show the growth of this space. And this is data that Preqin put out in the early 1980s. When I was beginning my career, there were 24 private equity general partners in the entire world.
No, you're kidding.
So yes, and now we probably have 24 were created just in the course of this podcast. So if you think about one of those 24, the ability to go and source product and source portfolio companies was just awesome. It's gotten much more complex, much more difficult, and we're certainly going through at least a growing pain stage. Some call it a bubble. I don't know if I necessarily would ascribe to that. But I still think there's a lot of upside opportunity. But where we are at this point in the market, I think at least a yellow light of caution is flashing, where if you're going to treat private equity as if we were back in the 1980s with just 24 general partners and they were going to get you an outsized return, not true anymore. The median returns look like the public market proxies, and this concept of dispersion, what the average managers earn, dispersion from that median up to the top quartile, separated by thousands of basis points. So it's really come down to a sector selection, manager selection, and due diligence is critically important.
Now that you've heard an excerpt from the upcoming episode on Sunday, make sure you stay tuned and connected so you don't miss a beat.